What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we are going to be taking a look at Netflix shares, see how they're trading on a technical basis, if this is a good entry point for investors, and we'll also be taking a look at the fundamentals of the business to see if the underlying business is growing and set up for future growth as well. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you will see within this video are as of market close on April 6th, 2026. Now, what we have in front of us here is the past 12-month price chart of Netflix shares. You can see that within that time frame, investors have received a 15.59% return. You can also see that shares have jumped in that prior to March time frame significantly, and that is because they pulled out their potential deal to acquire Warner Brothers Discovery, and the market rewarded that. We'll touch base on that later on in the video, but prior to that upswing in March, shares had a peak to trough decline of almost 45%, 43% to be exact. Now you can see that shares are trading just above that 50-day moving average, which is that green line, and below the 200-day moving average in that orange line. Now, that is showing fair value when you look at the relative strength index in the short term, because shares were on such a downtrend really since last fall in September, October. Shorter term, shares are showing that there is overvaluation in the name, but longer term relative strength is showing a actual slight discount to long-term growth. Now, you can see here there are 46 analysts that cover Netflix. They have an average price target of $112.94. That does imply from the 98.93 close on April 6th, a 14.2% return if shares hit their price target. That is not bad. Now, a lot of these analysts have revised down their target prices in cohesion with the decline in shares for the past 6 months. Some have started to gradually increase their price targets again, and some have lagged in that sense. So there's a little bit of a lag in terms of the price targets and where shares are trading right now. But you can see the underlying business is actually growing 16.5% over the past 12 months. That is above both the industry and the benchmark average. But you can see there on that 10-year trend in sales, there has been a little bit of a maturity in sales growth, and that is standard with companies that become so large. Obviously, 10 years ago, Netflix is not the same size and same company as it is today. So that is just through the law of large numbers, and through just becoming such a large company, you do see those sales declines over time. What we'd like to see is gross margins. They are trading slightly below, around a 48.6% gross margin, which is below the 49.2% industry average, yet still above the benchmark gross margin profitability. Now you can see from that gross margin to net margin, it is actually, Netflix has a higher net margin than both the industry and the benchmark at 24.3. They've been very prudent. They've been disciplined in how they manage their balance sheets and how they manage their debt issuance, and also their equity dilution as well. And they're also not investing that much in CapEx relative to other tech companies. I know in the previous video we mentioned Meta, that was having CapEx of almost $135 billion over the next 12 to 24 months. So Netflix is making smaller acquisitions and partnerships to counteract that. And they're obviously not going to have the same build out as other of the Mag 7 names, let's just say in Google, Amazon, and Microsoft that we've analyzed in previous videos. You can see on a valuation basis over the past 12 months, the PE is 39.1 with a forward PE of 29.6. That is actually well below the 10-year average, which is 60 to 90, which is quite surprising. Again, Netflix was in growth mode and it is now a much larger company, but you can see that earnings per share growth of roughly 20 to 25% through 26 and 27. And this bar chart does a great job of outlining that. So even though we're talking about Netflix's maturity as a business, they're still having sales growth, earnings per share growth, and underlying growth in their business. And a good example of that is their ad revenue, which is expected to double in 2026 to $3 billion and keep growing longer term, which on this channel, we want to be long-term investors. And having that ad revenue growth forecasted through 26, 27, and beyond gives us that confidence and satisfaction in holding this name for the next 12, 24, 36 months and beyond. In fact, Netflix is rolling out its own proprietary ad platform, which allows them to cut out the middlemen and capture higher margins on every commercial that they show. As well, they have their cheaper ad-supported tier, which acts as a safety net for price-sensitive consumers in these environments where we're having higher price of goods and inflation in both the macro and the micro economy in consumers' pockets. Having this cheaper ad revenue is going to ensure that globally their subscriber count does stay above that 325 million mark. Again, maybe you might not be doing that premium at the $27 mark, US dollar mark. Let me use this as an example. You may go to the ad supported tier at $8.99. That is a significant price cut for consumers, yet it continues to have the ability for Netflix to have a baseline of 325 million subscribers worldwide. Now, we mentioned about that Warner Brothers deal, and some investors are saying that was a failure. There were some that actually wanted to take part in the acquisition, but overall, you can see how shares traded after that news came out. Wall Street has rewarded the name. Now, why is that the case? You would think that acquiring a company and giving more offerings to consumers would be beneficial. But the way that Netflix was going to acquire the name was actually through debt and equity issuance. And if we're taking long-term debt, you're going to shrink your margins. And if you're diluting shareholders, you're going to really have large institutions pull out their money rather than having that share dilution. Now, by staying the course and being financially responsible, Netflix is now going back toward their simple model, which is creating content, selling subscriptions, and running ads now, actually, rather than becoming a large media conglomerate that has no future path forward. Now, Netflix's international segment is its driving force, where in some region, Netflix makes up less than 5% of viewership. So with development of more international content that we see on their platform and investing in these regions, Netflix can gain market share and boost revenue in international and developing markets. We mentioned about that premium tier of $27. That is kind of showing and allowing Netflix to flex its muscles in a sense. They know that consumers are going to remain loyal to the platform and are going to continue to pay those prices, whether it's a $1 or $2 hike. And just in that case, these hikes are just expected to add $1.7 billion in revenue this year alone. And assuming that these kick in April or May, analysts believe that the increase can contribute 250 basis points of growth in 2026. And the price increases did come earlier than analysts expected. They did expect it to come out in the second half of 2026. The increase may already be factored into Netflix's 2026 revenue guidance of 12 to 14% growth. Now, the company as well is also forecasting a healthy 31.5% operating margin for 2026, which is aided by generative AI tools that are streamlining content production and back-end operations. I do just want to mention that Netflix, again, is not spending the same scale and breadth as the other large tech companies, but at the same token, they're not having to spend the same amount and at the same scale and at the same velocity as their competitors in Disney Plus, in Amazon Prime Video, in Apple TV. That is because Netflix has had the first mover advantage and has such a deep library of content where they're not having to spend at the same amount to catch up and gain that streaming market share. On that same token, Netflix is business is transitioning a bit from that old movie and show library to a must watch now destination with rights to a variety of sports like NFL Christmas games, the World Baseball Classic, and WWE Raw partnership. Netflix is capturing the one thing traditional TV and cable providers still had, and that is the live, unskippable audience that live TV and sports games and entertainment provide. This can improve margins and revenue in their ad supported space as well because they're going to have more eyeballs that are driven to the platform, fans of these various sports. And as even in international markets, let's just say cricket, for example, and they get rights to a variety of cricket events, that will drive revenue at the bottom line overall for Netflix, but will also drive growth in those international markets where Netflix is lagging behind local providers significantly. Also, the 2026 content library is packed up, and you can already see that with the release of the Peaky Blinders movie. There is the Narnia movie, The Magician's Nephew, coming out as well, and with newer series coming out through 2026, which may have and spark fan interest, which will drive more eyeballs to the platform, and obviously with the hopes of quarterly signups being sticky and be reoccurring for years and quarters to come. Now, I wanted to mention that even though Netflix has had solid long term growth, there is a worry in the market of how long that can last. Again, we noticed and we saw those sales numbers slowing down. That is an indication that a company has been getting large and quite large in Netflix's example, and investors don't know if that same growth, and you can see that with the multiple as well, it is trading below that 10-year PE multiple of 60 to 90, but that is because Netflix has had such large growth, and analysts don't know, and nobody truly knows if they're going to have that same growth going forward. Again, there is potential with the ad supported space in international and developing markets as well, which can ease those bears. But as I mentioned, Netflix isn't spending at the same capacity as their competitors. Someone is coming for their crown, so they do have to be on their toes, making smart acquisitions and partnerships with the right studios and the right film houses. And backing out of that Warner Brothers deal provides them with a boatload of liquidity and capital to go out and acquire content houses or provide their own in-house content so subscribers can stay on the platform longer. As always, this is not investment or financial advice. I thank you so much, guys, for making it to the end of the video. Please do hit that like and subscribe button. It does mean a lot to me, and stay tuned for the next video.